Welcome to The Explainer. Today, we're going on a guided discovery journey together. We're looking at a structural transformation in global finance that's happening right under our feet. For centuries, our relationship with our money has been defined by heavy doors, giant vaults, and towering institutions. But the ground is shifting, and it's shifting incredibly fast. We're going to explore exactly why the very foundation of retail banking is undergoing a profound, permanent rewiring.
For 600 years, a bank was where you kept your money safe. In 2026, software started doing it better. I really want you to feel the heavy historical weight of that first sentence. 6 centuries of human habit upended by a few lines of code. It's a sudden, almost violent velocity of technological change. And it forces a pretty uncomfortable realization. When did we stop needing a building to trust our money? I mean, think about your own habits for a second. When was the last time you actually walked into a physical branch? We've been slowly detaching from the physical reality of banking for a decade, but something profoundly different is happening this exact year.
Part 1. The 6 original problems, or why banks existed in the first place.
Okay, let's dive into this by taking a step back. To understand why banks might be replaced, we have to understand why they were invented to begin with. Every financial institution on Earth exists to solve 6 original human problems. First, trust. You needed a neutral third party so you didn't have to carry actual gold across a desert. Second, record keeping. Someone had to maintain the master ledger of who owned what. Third, payments. Moving value from person A to person B securely. Fourth, lending. Connecting people who have surplus capital with the people who need it. Fifth, identity. Verifying that you are exactly who you claim to be. And finally, risk management. Protecting your assets against theft or loss. For hundreds of years, you had to have a centralized corporation to do these 6 things.
But here is the quiet revelation. In 2026, technology solves every one of these problems right now. Not in a theoretical white paper, not in some future decade, today. Cryptography solves trust and record keeping. Decentralized networks solve payments and lending. Biometrics handle identity. Smart contracts take care of risk management. The original purpose of the physical bank building is entirely digitized.
Part 2. The 4 forces converging in 2026. You see, it isn't just one technology driving this, it's 4 massive forces converging at this exact moment. The first force is agentic AI. The International Monetary Fund, in their 2026 official notes, now uses the exact term agentic payments. What this means is, AI agents are moving money autonomously, restricted only by constraints that you set. This is not some speculative concept. When the IMF officially classifies it, you know it's real, regulated movement. Your money is no longer passive, it has an independent engine.
The second force is regulatory clarity. On June 22, 2026, the Bank of England finalized their rules for stablecoins. At the exact same time, the European Union's MiCA framework, their comprehensive crypto asset regulation, is fully active. Stablecoins are no longer the Wild West of the internet. They are heavily regulated, state-approved financial plumbing.
The third force is tokenization. $30 trillion. Let's just let that number breathe for a moment. That is McKinsey's massive projection for the size of the tokenized asset market. The future isn't just trading digital coins. It's an entirely new on-chain architecture where deeds to houses, corporate stocks, and government treasury bills are completely digitized. They'll move across networks as seamlessly and instantly as sending an email. And the fourth force is open finance APIs. Application programming interfaces are the invisible messengers that let different software talk to each other. They're effectively replacing physical bank branches. Because of APIs, your M-Pesa account, your traditional savings, and your crypto wallet are no longer isolated islands. They become one continuous, machine-readable financial layer that an AI can navigate in milliseconds.
Part 3. The secret deposit drain and what no one talks about.
So the crucial point is how these 4 forces trigger something entirely unprecedented. This is the most important shift, and it's genuinely surprising. According to McKinsey research, traditional banks have always relied on one quiet, incredible advantage: human laziness. For decades, banks have relied on people leaving their money sitting perfectly still in low-interest checking and savings accounts. You get paid, the money sits there earning almost 0%, and the bank lends it out at a much higher rate. That spread, that is the fundamental engine of legacy bank profits.
But consider this contrast. A human leaves money idle. An AI agent does not.
Imagine having a personal AI financial manager sitting right on your phone. Its entire job is to scan global networks every second of every day. If it finds a secure, regulated protocol offering a higher yield, it moves your idle money instantly. It optimizes your capital in real time. When millions of personal AI agents start draining idle deposits to chase real-time yields, that historical advantage for the legacy banking sector is permanently erased.
Part 4. Banks are fighting back. The race to transform.
Now, we have to present a fair and balanced picture of the landscape here. Legacy institutions absolutely recognize this existential threat, and they're reacting fiercely. Boston Consulting Group projects that by 2030, banks that successfully transition to an AI-first model will see a 40% reduction in costs and a 30% gain in profitability. Let those statistics sink in. Banks aren't necessarily disappearing, they're transforming into technology companies.
To see this in action? Just look at the hiring boards. 300. In June 2026 alone, Lloyds Banking Group hired 300 AI technology experts. Traditional banks are ripping out their legacy systems and trying to rebuild the ship while it's already sailing. The real question isn't whether they will change, but whether they can transform fast enough to beat the agile, decentralized networks that were born digital.
Part 5. The East African Blueprint. Proof from Kenya.
Let's look at how this builds a larger global narrative, especially for our audience here on BizRe. If you want to know what the future looks like, you don't look at Wall Street, you look at East Africa. In 2007, Kenya launched M-Pesa. It allowed millions of people to transfer value via mobile phones, letting an entire generation skip the traditional branch bank entirely. Through the 2020s, African fintech companies raised billions in capital precisely because the continent never needed a brick-and-mortar branch on every single corner. They proved that mobile, decentralized networks work at a massive scale. And now in 2026, the Central Bank of Kenya is actively exploring a digital shilling. You see, Kenya isn't behind the curve. Kenya is the geographic blueprint. The rest of the world is just now catching up to what East Africa already figured out.
Part 6. The Invisible Future Bank. 5 years from now.
So as we pull all these puzzle pieces together, what does the financial world look like for you, the curious student of innovation, just 5 years from now? Well, the traditional bank survives, but its role drastically changes. It completely stops being the face of your financial life. The bank becomes invisible back-end infrastructure, like the engine of a car you never actually see. Your personal AI agent becomes the steering wheel, the dashboard, the only interface you need.
Think of it this way. TCP/IP is the foundational communication language of the internet. It's what allows an email to travel across the globe instantly. We are currently building the TCP/IP for finance. Money is starting to behave exactly like information. Your personal AI will simultaneously pull from your legacy bank account, your stablecoin wallet, your tokenized real estate investments, and your government pension, routing value seamlessly across networks at the speed of light. Which brings us to the ultimate crossroads of this entire explainer. Who do you trust more with your money in 2026? Your bank or an AI? And should those even be different things anymore? Tell me in the comments. So here's what I want to know from you. Drop it in the comments. Is your bank already obsolete in your life? Or do you still trust it more than an AI ever could? Let's actually talk about this.